Right, so I thought I would just do this video because we have so many people who ask questions about the wealth section of the Harbour Club. So obviously the wealth section, we kind of put it's the last thing on the last day, and we probably give it about 10-15 minutes of discussion, where it's actually quite a big topic to go through, and I think it's really important for people to understand all of the concepts and the way that it works, because it can be really life-changing, and it can have a really big impact on you and your personal wealth and your life and your lifestyle and everything like that. And yeah, after 3 days of me bombarding you with information on the Harbour Club and all that new stuff that you've got to kind of soak up, it possibly too much of a whole new area to embark on. So I thought I would do this this video so that you can get a more rounded kind of understanding of the concepts in there. So I guess the first thing is that most people are in business or want to use business to create wealth for themselves and their family. But interestingly, not that many people measure their wealth. And as you know, through the Harbour Club, I always talk about this idea of everything measured improves. So the metric that you choose to measure for anything tends to be the thing that gets better. So what happens is that people want to be wealthy, but they focus on other things like sales, marketing, hiring and firing, and other things like that. And consequently, the wealth thing gets put kind of in the back burner. Now, there's lots of advice out there, and there's lots of people that say, just follow your passion, do what you really enjoy, the wealth will come. And yeah, I kind of agree with that to an extent, but actually, if you really measure your wealth, you'll notice that it starts to get better quite a bit quicker. So the first thing that we suggest is that you create a personal balance sheet. And this is really just an understanding of where you are right now. So what is your net worth? Now, we're going to use the rich dad, poor dad, Robert Kiyosaki approach to this, which is that you do not include your primary residence or your business. Now, this is quite an important way to look at wealth, because for most entrepreneurs, that's pretty much all they have. They have a house with a mortgage and a business that they're running. Now, if that business fails, it can quite often mean that the house goes too. You can't keep up mortgage payments and everything falls apart. Even if you don't have a mortgage, if you've got a mortgage-free property that you're sitting on, you could find yourself in a position where you're unable to pay your property taxes and end up going into bankruptcy. So, businesses are very dynamic things. They change all the time. You can't really rely on the value of the business from 1 year to the next. So in the personal balance sheet, we want to measure what are your investments outside of your primary residence and your business. And it actually does call in to this idea around sort of a poverty mindset and a wealth mindset. So I often ask people the question, what would you do if I gave you $3 million? And it's really interesting to hear what people's answers to that question are, because basically the poverty mindset, which I used to live in for many years, and most people do, the poverty mindset says things like, I would pay off my mortgage, or I would buy a house, or I'd buy a car, or I'd buy a house and a car. That's the typical first things people would do with their 3 million. And that's a poverty generating way of thinking. It doesn't help you in life going forwards. The wealthy way of thinking is that you invest that $3 million in buying income. So you buy $3 million worth of income. And then that income gives you the financial freedom, because income coming in on a monthly basis without you having to do anything, so capital properly deployed, is real financial freedom, because then you can pay your living expenses from that capital that's deployed, and you have all of your time free. And if you do make income, then you can invest all of that income. You're not having to use it to live off. So poor people tend to buy primary assets, rich people tend to buy income, because they recognize that income is freedom. The challenge is people aren't terribly well educated on what they can buy for income. So people tend to focus on things like buy-to-let properties. Now, buy-to-let properties are great. It's a good idea to have some in your portfolio, but it shouldn't be all of your portfolio. It should be a small percentage of all of the things that you do. And you have to remember as well that a buy-to-let property isn't really an investment, it's a business. It has customers, the tenants who rent the property. It has costs associated with maintaining that passive or so-called passive income. It has, you might have to fix a boiler or repair a roof or change property every so many years, put in a new kitchen or a new bathroom every 5 to 10 years. So it's not that passive. It's actually what you do when you buy to let properties is you're creating a small property business. Now that's fine, but just understand that's what you're doing. Understand that that's a property business, that's not passive income. Passive income, you literally fire and forget, and it just, the income rolls in while you're sleeping and you don't have to think about it. And I think that's a really important distinction. A property business is fine, passive income is passive income. It's something, it's passive by definition. So create your personal balance sheet. So your personal balance sheet is all of your investments outside of your primary residence and your business. So this would be stocks, bonds, maybe real estate investment trusts, maybe a buy-to-let property, anything that you have that you've invested in outside of your primary residence and your business. And now the next thing I want you to do is to create a habit. And that habit is that you regularly review that personal balance sheet and that you deploy any surplus cash you have into further assets so that you're growing your personal balance sheet. So I personally, every Friday, have my wealth day where I go through, I've got numerous bank accounts all over the place. So you have a sweep up of all of the cash in the bank accounts and transfer it into the investment accounts and deploy it into various different assets. And we'll come on to what those might look like soon. So make a habit of tracking your wealth and make a habit of deploying cash into investments. I remember one of the Harbour Clubbers, actually he was the guy that inspired me to add the wealth section to the Harbour Club, because he came on the Harbour Club, had this dawning realization that actually his net worth was zero, but he was sitting on 600 grand's worth of equity in his house. So he actually sold his house, put that 600 grand into investments, which generated enough income to pay all of his living expenses and rent a house that was bigger than the one that he sold, and basically became completely financially free. So it was like an epiphany for him. So he shared this story with me and I thought, actually, that's a really great story and that's worth sharing in the Harbour Club. So I built the wealth section into the Harbour Club after that. And basically he took his personal balance sheet from zero, because it was all tied up in his primary residence, to $1 million in about 6 months. So the house was 600 grand of that, but he got the rest of it through just regular deployment. So every Friday he would sweep his accounts and invest it. And he told me a funny story one time, which was because he chose Friday because I'd mentioned Friday. So he on Friday he emptied all of his bank accounts, invested it in the things that he was looking to invest in, so buying his stocks and his shares and his bonds and everything like that. He said he went out Friday morning and realized he didn't even have enough money in his account to buy himself breakfast. So he'd literally swept his bank account so empty he couldn't buy himself breakfast on Saturday. So he spent the weekend kind of living a very nice frugal life, but he actually felt proud of himself on the Monday for having done it, because he basically cut all of his expenses for that weekend, but he grew his personal balance sheet. So his personal balance sheet was on this relentless trend upwards. So he got a kick out of seeing that improve. So I'm not suggesting you go that extreme. I'm actually not a big believer in all these wealth gurus and things that say, well, cut out your Starbucks and cut out this and cut out that, because, if you take the $3 you spend on a Starbucks times 300 a year, that's another $900. You could do this, that, and the other with it. Honestly, $900 is a piss in the ocean. It's not going to touch the sides of actually achieving anything. And I would always focus on increasing the flow of income and the flow of funds coming in, rather than wasting too much time cutting. I mean, clearly, if you have crazy spending habits, you need to get that under control so that you're spending the money that you earn from your investments, not spending the money that you could be investing. And that's really the next thing that I want to talk about. So the first thing was getting your personal balance sheet in place. The second thing was making it a habit, reviewing that personal balance sheet and reviewing your investments on a really regular basis, so that you make progress, so that everything that you're measuring is improving. The thing that you're focused on gets better and better over time. The next thing I want you to do is I want you to really sit down and calculate your expenses. figure out what it is you spend on a month-on-month basis. So whether that's your mortgage or rent, plus operating your car, food, entertainment, cost of kids' clothes, schooling, all of that kind of stuff. Just put all of that stuff into a spreadsheet, into a long list of what you need going forwards. Now, what I often recommend is focus on what's your minimum, what's your kind of survival number. So if you really had to scrape by, and just live on, the bare minimum, how much does that look like? And then what's the desired amount? So kind of the comfortable lifestyle with the things that you want. And then what's the goal amount? What would you like to be able to blow on extra holidays and shopping and luxury items and things like that? So you kind of have 3 targets then going forwards. Now, let's just say that you've done the calculation and you've figured out that you're spending $10,000 per month, so 120,000 per year. So your next goal is to figure out how you can generate 120,000 a year using or from passive income, so that effectively all of your day-to-day expenses are covered by the income from your investment. Now, a really interesting thing happens here. When you can cover 100% of your expenses from the income from your investments, you have real financial freedom. And not only do you have real financial freedom, but at that point, your net worth and your wealth will start to snowball upwards, because as soon as you can live off your investment income, it means you can invest 100% of your income. So what it means is everything that you go out into the big wide world and earn, basically you're going out into the big wide world under no pressure. Once the pressure's off, people perform a lot better. So you're going out into the big wide world with no pressure, and everything that you earn, you can then deploy into further income generation. And then the surplus income, you can either use to live a slightly more extravagant lifestyle, or you can compound it and roll it back into the investments. And Albert Einstein described compound interest as the 8th wonder of the world. It really does transform things. But if you can add compounding plus deploying 100% of what you earn into further investable assets, then that really becomes the game changer. And you need to get to that position as quickly as possible. So that's the goal. We're trying to get this 120 grand's worth of income. The next thing then is how you achieve that. Because if you use a deposit account with a bank, you might get 2% per year. So in order to make 120,000 a year, if you're only getting 2%, you have to have like millions, tens of millions deployed in order to get that. In fact, it would be 24 million, I think, if my maths are correct. So you'd need to deploy 24 million dollars. So 10% would be 2.4, 5% would be 1.2. So yeah, maybe I've got the maths a little bit out, but yeah, you'd have to have a huge amount of money deployed in order to get that sort of, to get a return at that sort of level. Now, if you were to buy perhaps a basket of corporate bonds and REITs and other things like that, you might get somewhere around sort of 5% return on your funds, which means to get to your 120, you're now looking at about $2 million deployed. Now, obviously, 2 million is a little bit more manageable. That's something that maybe people can relate to. But the real game changer is when you build a core portfolio with a private wealth bank. Now, private wealth banking basically allows you to access products that can give you a much higher return. But the most important thing is they provide you with leverage, which enables you to get a positive carry on your return. So how this leverage works is if you were buying a buy-to-let property, how it would typically work is you would put a 30% deposit down. The bank would give you the other 70% as a buy-to-let mortgage. Sometimes it's a bit less than that, but 60, 70% is quite normal. And then you would pay interest on that mortgage, and that might be anywhere between 3 and 5% in current the current climate. Can be a little bit more. Buy-to-let mortgages, they're always a little bit more greedy on the interest rates, but let's just say 3 to 5% interest charge. And then the idea is that your rental return is greater than that 3 or 5%, which means you get the positive carry. So effectively you make a profit on the difference. Now, obviously the risks can be that interest rates go up and that creates a squeeze on your profit margin, or that asset values go down and that can create a squeeze on the loan to value you have in the portfolio or in the property. So exactly the same thing is true for investable assets. So if you're buying stocks, bonds, or derivatives, they all have a loan to value just like a house would. And depending on the quality of the asset, depends on how much the bank will lend you against it. So for example, I can take out a Royal Bank of Scotland bond, which is effectively a debt instrument. It means that the Royal Bank of Scotland owes me, I'm lending the Royal Bank of Scotland money and they will pay me an interest charge on it every month. Because the Royal Bank of Scotland is owned by the British government, or 70% owned by the British government, it's classified as sovereign debt. So sovereign means it's the country that you're lending to rather than the company. So the ultimate backer, if you like, is the government of the UK. And so consequently, the loan to value on that RBS bond is 95%. So you get a really good return. There's a Franklin Templeton bond fund that I quite like in my portfolio. It pays out every month. It's 7.5% or something return. It's got a really good basket of bonds inside, so it's well diversified. And that one has an 85% loan to value because, again, they're seen as a lower risk, lower volatility investments. And then you take equities. Well, obviously equities can be a bit more volatile. So if it's a blue chip company like Apple or Microsoft or someone like this, you would get around a 70% loan to value. And actually the same is true with real estate. So if you buy real estate investment trusts, which are effectively portfolios of real estate held in publicly traded securities, so that you can buy and sell them more easily than you can buy or sell a piece of real estate, they would typically have a 70% loan to value as well. So what that means is that if you want to buy $100,000 worth of a real estate investment trust, if you want to, you can just put $30,000 in and the bank will lend you the balance of 70% and you get the income from the whole 100%, but you have to pay the interest on the 70%. But where it gets interesting is that in private wealth banking, you can actually get an interest rate of 0.7% a year on top of the prevailing interest rates. Now, there are several countries in the world that have negative interest rates, the European Union being the most, or one of the bigger ones, Japan obviously as well, and Sweden, Switzerland, and a few other places. So if you borrow in, say, Swiss francs, which is not very volatile at all, in fact the Swiss franc, I think the maximum move in the Swiss franc in the last 10 years has been about 6% in total. You know, very often it only moves a tiny amount. Even when they say, there's a flight to safety and the Swiss franc has soared, when they say soared, they mean it went up 200 basis points or something, so it went up by 0.2%. So quite often you have to, when you're listening to CNBC or the news, you have to take into account when they say, the bond market has collapsed. Sometimes it's it's 0.20, 0.25% that it's gone down. So if you use these negative interest rate currencies like the Swiss franc as the lending currency, you effectively get 0.7% interest rates per year. So you can have very, very low cost of borrowing and a very high positive carry on the underlying asset. So obviously, with currencies come risks as well. So it's always good talking to an investment advisor about how you balance the currency. So you wouldn't have everything in one currency, but you might balance the currencies between pairs that often react against each other. A good example is the euro Swissy. When the euro goes up, the Swiss franc tends to go down and vice versa. So you can often create a hedge around the currency aspect to ensure that you're getting a low interest rate but not exposed too much if a currency were to make a dramatic move. So basically, just like when you buy a house and you have a mortgage, with securities you can have margin or a Lombard loan, which is basically this very, very low interest loan that you can then use to get that positive carry. So you buy a house, buy to let property, maybe you get a 6-7% return on your capital. You have a mortgage of 5%, so you're getting a positive carry of 2%. With a real estate investment trust, You still get your 7% return. You don't have to fix the boiler or deal with the tenants. You still get a 70% margin or loan against it, but that loan is at 0.7%. So the positive carry is much higher. Because and also the deal with a Lombard loan is you can pay it off whenever you like, you can draw it down again whenever you like. So it's very easy to unlever the investment. So with that income that's coming in, you can gradually reduce the leverage, or as you top up with new funds, you can reduce the leverage. So the advantage of using leverage, because I mean, you know, the risks always come with debt, so you have to be aware that there are risks with debt. But the advantage of doing this is that you can very quickly get to your desired income level, so your 120 grand a year. And then when you've got your 120 grand a year coming in, that means that all of your income is now unencumbered. So you have all of your day-to-day expenses covered. So now you can invest 100% of your income. You can use that 100% of your income to buy assets that don't have any leverage, so that you just own 100% of. And what that means is that the overall portfolio grows and the percentage of leverage disappears. So, so effectively, you, instead of delevering, which is actually paying off the debt, what you do is you increase the asset value, so that your income stream remains intact, but you're reducing your risk, you're reducing the levels of leverage. If you're going to calculate how much cash you need to have deployed in order to achieve your 120 grand with a private bank, you'll be amazed to know that using the core portfolio that I'm going to talk about next, you can get, with an aggressive amount of leverage, around a 30% return across your portfolio, with a less aggressive approach, around 20% return. So let's put that into some context. If you're on a 30%, I mean, you can actually get a little bit higher than 30%, but let's just say it's 30%, then you're looking at more like 400,000 invested, giving you your 120K. And if you're looking at a 20% return, then it's just 5 times this, which is 600,000 invested. When you put it into those terms, getting to 400 grand invested or getting to 600 grand invested in order to achieve your 120,000 a year income, that's a lot more achievable. That could be a single capital event from maybe sourcing a company that goes into an agglomeration and goes public, or selling the company that you have, or selling your house if you want to do the Harbour Clubber example that I gave you earlier. This is a lot more achievable to be able to go and get 400 grand. And that could happen from, yeah, like I say, finding a business, buying it, turning it around and selling it, or taking a stake in a business that you sell, or finding a company for agglomeration, which would be a very quick and easy way to achieve this. So when you look at it in those terms, you know, life gets a lot easier. One of the key things to this is obviously having the private wealth banking relationship. Now, private wealth banking is the game changer because of the Lombard lending and the access to products, which is really key. In fact, some of the products that I talk about on this video are only available through private wealth banking. And even if you go to the same bank, but in a European Union jurisdiction, for example, they won't offer you these products. You have to buy their retail products, which have much higher costs, much lower returns. Often you don't get any, if you want to do the sort of stuff that we're talking about, often they'll only do that under a managed account where they look after it for you, which is terrible. So you do need to go to the offshore banking places like Singapore, Hong Kong, Switzerland, you know, those kind of places which have, you know, very strong banking regulation. These are not, you know, tin pot, hot sandy places. These are grown-up jurisdictions, but they have they allow their private wealth clients to invest in the full smorgasbord of opportunities that are out there. So it's very important to get on that private banking ladder. The easiest ways to get on that private banking ladder are to deposit a load of publicly listed shares, or deposit a large chunk of cash. Typically, you would need around $1 million of cash, maybe, you know, US dollars, that is maybe 650,000 pounds sterling, 1.3 million Singapore dollars, something around there as a kind of deposit amount, and you need to prove a net worth of around 10 million. Now, proving the net worth of around 10 million is a little bit easier because they do include your primary residence and your business, and of course people can very much overinflate what their business is worth. So the 10 million net worth is is the easy part. The cash deposit can sometimes be the hard part. But if this is something that you want to do, we will do everything we can to try and help you. We obviously have a fantastic relationship with Bank Julius Baer. Now they would be very strict on the criteria, particularly around the cash. But if you're depositing securities, so if you did an agglomeration, for example, and you had a big chunk of MBH shares, that would be the perfect opening balance for somebody like Julius Baer. If you don't quite get to their criteria, there are other private banks, small private banks, that might be a little bit more flexible on the basis of joining, and so we have ways of introducing people there as well. Just because we've had so many people ask us over the years, we've created these relationships. Yeah, if it's something that interests you, reach out and we'll see if we can find a bank that will meet your circumstances, and will also help a little bit as well, just saying that, you know, you're a business partner of ours, we're doing deals with you, etc., and try and help get you on that ladder, because it's really a game changer for creating wealth. And obviously, as you know, my passion is around democratizing wealth and making this available to as many entrepreneurs and business people as possible. So if I can help you get on that ladder, I will do. And let's see if we can get your wealth snowballing in this way. So the next thing that we're going to look at is the core portfolio. So this core portfolio that's going to generate this this income. Now, you'll always hear financial advisors and people talk about the importance of diversification, and I am a big believer in this as well. It's just it's a fact, it's not just common sense, that you need to be well diversified in your portfolio. So within our core portfolio, we're exposed to 3 primary asset classes. So the 3 primary asset classes that we look at are real estate, debt, which is bonds, and equities, which is stocks and shares. And these are the 3 core asset classes that we focus on. Now, all of our focus is around generating income, because we're trying to replace your income. So this core portfolio is normally positioned in the most aggressive income generating way that you can. So for real estate, we focus on high yielding real estate investment trusts. Now, real estate investment trusts are a great way of exposing yourself to real estate, because if you've got, say, $200,000 to deploy, you could possibly put a deposit down on 1 commercial property, or you could buy, maybe put deposits down on 2 or 3 residential properties. But then your eggs are all in one basket, either in a commercial or a residential investment, all in one country. Plus, as I said, it's a business. You've got tenants, you've got things to fix, you've got all of the ramifications that go with that. Now, really, if you want to own real estate, you should be diversified. Now, within real estate investment trusts, you can buy, as little as $1 worth of real estate, and you can buy real estate in, say, hospitality, which is hotels. So this actually owns the hotel building. So quite often, if you go to stay in a Marriott or a W hotel or something like that, it doesn't belong to Marriott or W. The building belongs to a load of investors, and then there's a 10-year or 20-year operator's license given to Marriott to operate that premises. So through the real estate investment trust, through a hospitality REIT, you can own a stake in that hotel. The next one would be medical REITs. So medical REITs are typically hospitals. So again, when people are looking at these big infrastructure projects like building a hospital, the companies that operate hospitals, or even the governments that operate hospitals, don't tend to build the infrastructure themselves. It will be a public-private partnership. And so again, investors get to participate in that, and then they get a very long-term rental agreement with the operator of that hospital. So that would be called a medical REIT. You then have industrial REITs, which would be factories and things like that. You have commercial REITs, which are office space. You have residential REITs, which are portfolios of residential properties. You have retail REITs, which is shops and shopping centres and things like that. So they even have REITs for data centres. So you can actually own the real estate that the data center operators use to run data centers. So there really are a load of different kinds of real estate investment trusts that you can participate in. And now the other really interesting thing is that they exist in lots of jurisdictions as well. So here in Singapore, we have lots of Singapore REITs, but we also have REITs listed here in Singapore which are exposed to China or to India or to Australia. You can buy real estate investment trusts in London, so you can be exposed to London, to Spain, to Madrid, to Paris, to all these places. There are loads of these in the US, so you can participate in US and Canadian real estate. So for your $200,000 that you're looking to deploy into real estate, you could actually probably quite comfortably put $1,000 into 200 different types of real estate in different jurisdictions that all gave you reasonable returns. So most of the REITs here in Singapore are between 5 and 7% return. A lot of the US REITs give you, 8 to 10% returns. In fact, one I talk about on the Harbour Club is called Two Harbours. So the ticker symbol is TWO, and that's around 11% annual return on your money. I've had that in my portfolio for, God, must be 10 years. And it's a lovely, consistent dividend payer. So if we just use that as an example, so if we have this as a real estate example, TWO is paying 11% return. It's got a 70% loan to value, and as we discussed, I can borrow 70% at 0.7% a year. So if I put 30,000 into that, I can buy 100,000 worth of it. That 100,000 worth of it, I get 11% on, so I'm getting $11,000 a year return from that. My interest payment on 0.7% on 70,000 is about $480 a year. Would be my interest. So from my 11,000, I take off 480, I'm left with 10.5. So from that one real estate investment, I'm getting 10,500 a year from 30,000 deployed. So that's a 33, well, it's a bit over, probably about a 35% annualized return. So now you can start to see, I guess, how you can get these 20 to 30. I mean, that's fully leveraged. You probably don't want to be fully leveraged, but you could get a 30% return, and you've got 5% headroom for a little bit of wriggle room in the early days. And then, like I say, once you've got your income, replacing all of your income, you can start throwing more money into that pot to try and deleverage that position. So that's a really good example of one of the real estate components of this portfolio. So real estate being the first one. Next one being debt. Now this would be bonds. I already talked about the Royal Bank of Scotland bond. That could be a good opportunity. The Franklin Templeton Bond Fund was another one that I talked about. So that one pays 7.5% a year. It pays out every month. Has an 85% loan to value. So if you do the maths on that, you can put in 15,000 and you get 100,000 worth of Franklin Templeton Bond Fund. That pays you 7.5% a year, so you're getting 7,500. But you've got the interest on the 85,000 that you borrowed, which is around about $600 a year. So you end up with about 6,900 positive carry on a $15,000 deployment. So that's what, very close to 50% actually. It's 45 or something percent return that you're getting on that debt. So we've got one investment at 35, one at 45. So again, averaging and with a bit of headroom, so not 100% leveraged, you can see how you could start to build up some really decent income here. Now, equities. So lots of people look at dividend-paying stocks. Dividend-paying stocks, because of low interest rates and the rush to yield, have basically got squeezed and squeezed and squeezed. In fact, I think the S&P aristocrats right now pay 1.6% a year. Which is basically the same as sticking your money in a bank, except you might get the capital appreciation on the stocks, but then you might not. So maybe that's a strategy, maybe it isn't, but it certainly doesn't work for the core portfolio strategy. So what we wanted to do is we want exposure to equities, but we want to be able to generate income. And so to do this, we use something called a fixed coupon note. Now, I could probably do a whole video course on options and things like that. It's a whole new area of finance that could be understood. But to keep this really simple, I'm just going to talk about these fixed coupon notes because they're a really, really effective way of getting exposure to equities and generating a really substantial income. Now, lots of people use these in different ways, but I will show you how I use them. What I do is I take the Julius Baer recommended stocks list. So they have a big long list of all the stocks that are listed around the world, and they have a buy, hold, or sell rating on those stocks. So I go through all of the stocks that have a buy rating, and they have a buy rating because Julius Baer believed that they have long-term value and that they have the opportunity to go up. They've got a team of analysts and people going through this stuff all the time. Of course, they're not always right, but they are right enough of the time to significantly improve your odds. What I then do is I choose from that list a shorter list of stocks that I agree with them on. So all of the things that I would really like to hold in my portfolio over the long term. Now, the challenge you have with the stock market right now is we've had 10 years of the stock market going up at the point of recording this video. And the challenge with the stock market going up for 10 years is every year you feel like this is the year that it's going to fall over. This is the year we're going to have a correction or whatever. Now, what's really interesting is if you look at corrections over the years, I think every 6 years there's pretty much every year there's a correction, or one or two corrections. Now, a correction is just a 10% drop, and then it tends to recover very shortly afterwards. Every 6 years or so, there's a bear market, which is where there's a more than 10% drop, and it's typically a persistent drop. Now, interestingly, bear markets in history don't tend to last more than 6 months. So actually, everybody's scared of bear markets, but it's 6 months out of every 6 years. So most of the time in history, we're in a bull market, but we occasionally enter a bear market, and all everybody thinks about is bear markets. And if you plot the stock market over a really long period of time, basically the bear markets almost disappear, and it's a fairly relentless ride upward. So of course, past performance is not a great predictor of future, but the fear that people have is that the market is going to collapse. However, I'm kind of with you on that. I don't want to be holding a bunch of shares that don't really generate much in the way of dividend yields and have been going up for 10 years, because the next thing they might do is to go down. So what we do is we use these things called fixed coupon notes. And what a fixed coupon note is, it's a derivative product that you buy from the bank that basically says, hey, look, if Apple, as an example, goes down by 20%, I'll buy it. So it's at $200 now. If it goes to 160, I'll buy it at 160. And the bank goes, okay, here's a contract for you to buy Apple at 160. And while you're holding that contract, it'll be a 6-month or a 12-month contract. While you're holding that contract, we'll observe it every month. And if it's below 160 at any point, any of those observation points, you'll end up owning it. And while you're waiting to own it, we're going to pay you this coupon. And now they pay you this coupon. It's an option payment, effectively. Now, if you just did it on Apple, it probably wouldn't be terribly exciting because Apple's a very strong, big company. But as soon as you add in other variables, you basically increase risk. And it's all done through a calculator that basically figures out where how much the bank is going to pay you effectively to hold this. What you're really doing is you're providing the bank with an insurance policy that it can get rid of some of these shares if the arse drops out of the market. And what you're saying is, I don't want to buy the market now because it's too expensive. I'll buy it if it goes down, please. So one that I quite like doing, and I think it's an example you may have seen on the Harbour Club, although I do use different examples, but the one I do quite regularly is Apple, Alphabet, Amazon. So Alphabet is the name for Google, if you didn't realize that, but Alphabet is their parent company, Google is the brand. So Apple, Alphabet, Amazon. So all of those three are, probably three of the best performing companies over the last decade, companies that you would definitely want in your portfolio long term, but is now the right time to buy them? Or is there a correction coming in tech because we've had such a storming run now with tech companies and they're all up, thousands of %. Would it be better to own it if it went down? So what you effectively do is you put those three in a basket and you say that, look, if they drop 20%, I would like to own them. We then put in some insurance, and the insurance is called a European knock-in. Don't worry too much about this. When you start dealing with the private bankers, they will take you through the product in full detail. But basically you have this thing called a European knock-in, and what that means is that if it drops 20%, you end up owning it. But if it drops even if it drops 20%, although you end up owning it, your capital is protected. So if you've got 100 grand, your 100 grand is protected. And it's protected all the way down to the knock-in level. Now, I normally set the knock-ins at 50% or 60%. So that means the stock has to drop more than 40 or 50% for you to lose any money. Now that would be a once in a lifetime crash. We've had a once in a lifetime crash in my lifetime, but I'm sure there'll be another once in a lifetime crash in my lifetime. They do happen occasionally. Sometimes they're sectoral. So we had the tech crash in 2001, which was very much focused on one bubbly sector. But a general crash was the 2008 global financial crisis. Actually, if you look at other crashes, 50% is hard to get to. But anyway, if there was a complete crash and it went more than 50%, then your capital is not protected and you would end up owning the stock at the 20% discount price. So it could have dropped 60% and you're owning it at a 20% discount. But I would still argue that's better than buying it at today's price and then having the 50% drop. So I would still say it's a worthwhile way of exposing yourself to the stock market, but only owning the stock market if it drops significantly from where it is today. So you put these baskets of companies together in threes. They have a calculating system in the bank that calculates all of these fixed coupon notes. So what you end up having to do is swapping the names around, because you might find that Alibaba, Tencent and something else gets a better valuation than if you put the Alibaba with this company or whatever. So when you put them in the right baskets together, you can optimize the income that you're getting from these fixed coupon notes. Now, the fixed coupon note is like a share in itself. It's like it's a financial instrument that you get. And they typically come in chunks of 50,000. So you might buy 50 grand, 100 grand or 200 grand or whatever it is that you want. I tend to do them, I tend to do 50 grand lumps regularly in the same three and get up to 200 grand exposure in any single group of shares. And effectively, they all have this 70% loan to value on the note itself. So again, you put 30 grand, you can buy 100 grand's worth of this fixed coupon note. And then you get them priced. Now, they tend to be priced anywhere between 10 and 20% annual return, again, depending on the names that you put in and the criteria. But I did 3 literally yesterday, and they were all around 11 or 12%. So it's 11 or 12%. Again, you're putting 30,000 in, you're getting 100,000's worth. You've got a small interest payment. So your return is about 30% return on the capital that's deployed. And basically that note sits there for 6 or for 12 months, depending on which one you do. And you only own the shares if at the observation points they're below 20% of where they were when you started. And you only put shares in there that are on a list of shares that you would like to own in a kind of model portfolio of shares anyway. So basically what we do is we have exposure to bonds, which is debt, we have exposure to equities, and we have exposure to real estate. So we're diversified across these 3 key areas. And between all of those, if you put them together, I mean, absolutely rinsing it, you can probably get a 35% return across those asset classes, but that would be completely leveraged to the max and picking all of the highest yield things that you can do, which is quite a risky position to be in. So by just toning it down a little bit, you give yourself some breathing space if there's a market wobble or somebody tweets something that affects the market valuation of anything that you're holding. So yeah, if you focus on a kind of 20 to 30% return, 30% being aggressive, 20% being a little bit less aggressive, then you can see that you don't need that much capital deployed in order to generate that income that you're trying to generate. Now, in the next video, I'm going to cover what you do outside of your core portfolio. So we've got some really interesting strategies. One strategy at the moment that's generating 40% return on funds, and how you can use these other sub-portfolios to really then maximize your upside once you've got your core portfolio taken care of. So I'll do that, we'll do that as a separate video that I'll come on to next, but I hope this has helped you get an idea as to how you can replace your income so that you can invest 100% of your income and so that you can start to really grow your personal balance sheet.